So, in the world of fintech right now, there's a wild story playing out. On one side, you have this massive billion-dollar gamble on an AI comeback. And on the other, a quiet giant that's just been printing money the whole time. This is a tale of two totally different ways to win, and we're going to break it all down. And, at the very heart of this whole thing is a really unusual matchmaker, a firm called Castlelake. They're this huge credit investor, and they are playing the field, funding two rival AI lenders at the exact same time. It's kind of wild. They're the ones writing all the checks and stirring up all this drama. And here's the real plash. You've got these AI lenders who are, frankly, desperate for a lifeline to prove their models actually work. And then you've got this veteran broker who is so profitable they don't need anybody's help. It's the classic battle, right? Disruption versus discipline. Okay, so first up, let's dig into the AI lenders, because they have just been handed an absolutely massive second chance, all thanks to this huge pile of cash from Castlelake. The two big names here are Pagaya and Upstart. And what's so fascinating is that the same investor is pouring money into both of them. Pagaya is getting a cool $500 million for AI-powered auto loans, while Upstart is landing a staggering $1.5 billion for consumer loans. Pagaya's model is actually pretty clever. See, they don't lend their own money. Their AI network is more like connective tissue. It links up traditional banks with these big institutional investors. So they're the engine behind the scenes, powering the loan approvals. And right now, they're making a huge push into the auto market. And, it really looks like that push is working. Pagaya's network volume jumped an impressive 36% year over year. We're talking $2.5 billion. That kind of steady growth, that quiet endurance, that is exactly what an investor like Castlelake loves to see. So for Pagaya, this $500 million check is about way more than just cash flow. It's about legitimacy. It is proof that they've survived what some people call the post-SPAC hangover, that really tough period after going public. It shows they're now a serious, data-driven player in the lending game. All right, let's pivot to our other AI lender, Upstart. Because if Pagaya's story is all about steady endurance, Upstart's is just pure drama. We're talking a spectacular crash, followed by an almost unbelievable shot at redemption. And when I say the crash was dramatic, I mean it. Upstart's whole business depends on investors buying the loans that its AI approves. But when interest rates shot up back in 2022, that funding just vanished. Poof. Their stock cratered by more than 90%. It was a true near-death experience for the company. And yet, after all of that, they just landed this, a $1.5 billion deal. It's basically a guarantee from investors to buy their future loans. This is a massive vote of confidence. It's a signal that the big money out there has not given up on their tech. This is their second chance. Their CEO, Dave Gordward, has always made this bold claim that their AI can rebuild credit from first principles. Well, this new funding finally gives them the stability, the breathing room, to actually prove it without having to constantly worry about where the next dollar is coming from. Okay, so while all of that high-stakes AI drama is playing out, there's this other company in the background that isn't begging for a lifeline. Nope. In fact, they're basically just a money printer. Let's talk about Interactive Brokers. While the AI lenders were literally fighting for their lives, Interactive Brokers was just thriving. They posted $1.25 billion in revenue, up 16%. And here's the kicker. Those same high interest rates that nearly killed Upstart, they caused Interactive Brokers' net interest income to surge by 29%. Incredible. So how do they do it? Well, their 80-year-old founder, Thomas Peterffy, pretty much sums up their entire philosophy in just 4 words. We execute and grow. It's blunt, it's simple, and it perfectly captures their no-nonsense, no-fluff approach to business. So what's their secret sauce? Well, forget about flashy apps or trendy marketing. You are not going to find any NFT wallets or influencer deals here. It is all about scale, precision, and super low-cost execution for serious, professional traders. They are just laser-focused on one thing: generating revenue, period. So here we have these two completely different stories, these two paths. What does this all tell us about what the market actually values in fintech today? You can see the two playbooks so clearly, right? The AI model is this huge bet on disruption. You have to survive total chaos and then use big investor money to prove you're the future. The veteran model is the total opposite. You build on the fundamentals, you scale carefully, and you just profit from the market exactly as it is. One tries to change the game, the other has already mastered it. And that brings us right to the heart of it all. What does the market really reward? Is it the massive, world-changing potential of some disruptive new technology? Or is it the boring, predictable, but proven profitability of a well-oiled machine? For now, it seems like the market is rewarding both. But that leaves us with one final question for you to think about. If you had to put your money down, where would it go? On the AI innovator that's chasing a historic comeback? Or on the quiet veteran who never left the top of their game in the first place?